There's a number embedded in federal law right now that directly determines what can happen to your bank account. Not someday in the future, not if something changes in Congress, but right now, today, in 2026. The overwhelming majority of Americans who have a checking account have never been told what that number is, what it triggers when your account crosses it, or what specific mistake can turn a completely innocent banking habit into a federal flag that freezes your funds, generates a law enforcement report, and, in documented cases, results in the government legally seizing money that belongs entirely to you without a single criminal charge ever being filed. The number is $10,000. And before you say you already know about the $10,000 rule, I need you to stay with me through what I'm about to explain, because there's a specific documented little known dimension of how this rule operates in 2026 that's fundamentally different from what most people think they understand. That difference is exactly where the danger lives for ordinary retired Americans who are simply managing their money the way they always have. I've spent years tracking the rules, the directives, the enforcement patterns, and the documented real world consequences that the federal banking reporting system creates for ordinary Americans. The story of the $10,000 rule is not the story most people have been told. It's not primarily about large cash deposits from criminals trying to hide money. It's primarily about retired school teachers, retired factory workers, retired government employees, and retired farmers who made completely innocent decisions about how to manage their own money. Decisions that looked suspicious to a federal algorithm, with no ability to distinguish between a drug trafficker and a 71-year-old widow depositing the proceeds from selling her late husband's truck. These people found themselves facing federal investigations, frozen accounts, and in too many cases, the permanent loss of money they had spent a lifetime earning and saving. This video is going to tell you the truth about the $10,000 rule in 2026. Not a simplified version, not a scarier version, but the actual truth about what the law says, what it triggers, what has happened to real people who fell into its reach without understanding it, and what specific actionable steps you can take right now to make sure your checking account never becomes the subject of a federal report you didn't know was being filed or a federal action you didn't know was coming. Federal law requires banks to report cash deposits of at least $10,000. This requirement has been in place since 1970 when the Bank Secrecy Act was signed into law, and it was expanded significantly by the Patriot Act in 2002. But here's what the headline version of that fact consistently leaves out, and what I want to make absolutely clear before anything else, because it's the foundation of everything we're going to cover. The $10,000 reporting threshold is not a limit on how much money you can keep in your checking account. It's not a cap on how much you can deposit. It's not a signal that you've done something wrong. A cash deposit of more than $10,000 into your bank account requires special handling. Your bank must report the deposit to the federal government, but depositing more than $10,000 will not result in immediate questioning from authorities. The report is done simply to help prevent fraud and money laundering. You have nothing to lose sleep over so long as you're not doing anything illegal. That's the official position. And in the straightforward case of a one-time large deposit from a legitimate source, that official position is largely accurate. The problem and the reason this video exists is that the real world of how this rule operates in 2026 is significantly more complex than that official position suggests. The threshold also applies to withdrawals of more than $10,000. It applies to certain cashier's checks, money orders, and traveler's checks above the threshold. It applies to a series of smaller transactions that are determined to be related. And structuring when an individual splits up several deposits so that a single deposit of more than $10,000 cash doesn't happen carries penalties including fines and possible prison sentences, regardless of whether the money being structured is completely legal and fully taxed. That last point is the one I need you to read twice. The criminal penalty for structuring applies even when every dollar being structured is legitimate, even when you owe no taxes on the money, even when the only reason you made multiple smaller deposits instead of one large one was that someone told you once that keeping deposits under $10,000 was smart, or that you read it somewhere online, or that it just seemed like the logical thing to do to avoid unnecessary attention. The intent to avoid the reporting requirement is what makes it a crime. Not the source of the money, not the tax status of the money, and not whether you actually owed anything to anyone. Now, I need to tell you about the specific change in 2026 that makes the $10,000 rule more consequential for ordinary Americans than at any previous point in the rule's 56-year history. And it's a change that most people covering this topic are not fully explaining. Executive Order 14,247, signed on March the 25th of 2025, directed the U.S. Department of the Treasury and the IRS to transition federal payments to and from the government to electronic methods. The IRS issued detailed guidance on January 27th of 2026, confirming that the agency generally stopped issuing paper refund checks for individual taxpayers after September 30th of 2025. The transition to a fully electronic payment system, the end of paper checks for federal transactions, has created a direct connection between your bank account and federal financial monitoring systems that's more seamless, more automated, and more comprehensive than anything that existed before. When your IRS refund, your Social Security payment, your veterans benefit, your federal pension, or any other federal disbursement arrives through direct deposit into your checking account, the transaction creates a data point in the federal electronic payment infrastructure. That data point, the routing number, the account number, the amount, the date, is now part of a financial profile that can be cross-referenced against IRS records, Social Security Administration records, FinCEN records, and the currency transaction reports that your bank files automatically every time a cash transaction crosses the $10,000 threshold. The monitoring infrastructure that previously operated as several separate, partially connected systems is now operating as a more unified, more automated, more comprehensive whole. The result is that the $10,000 rule, combined with the behavioral pattern analysis built into bank fraud detection systems, is generating federal reports on ordinary Americans at a scale that was simply not possible before the electronic payment transition was complete. The specific mechanism that's catching seniors most frequently in 2026 is not a large single deposit. It's a pattern. Understanding how patterns trigger the system independently of any single transaction crossing the $10,000 threshold is the knowledge that most seniors who fall into this situation never had before the report was already filed. Banks are required to file currency transaction reports for cash transactions above $10,000, but they're also required under the Bank Secrecy Act and under the enhanced monitoring frameworks that have accompanied the electronic payment transition to file suspicious activity reports when they observe patterns that are inconsistent with the customer's known financial profile and that could indicate structuring, money laundering, tax evasion, or other financial crimes. Suspicious activity reports have no minimum dollar threshold. A series of $9,000 deposits, each of which is individually below the currency transaction report threshold, and each of which would individually generate no report at all, can collectively trigger a suspicious activity report if the pattern suggests to the bank's automated monitoring system that the deposits are structured to avoid the reporting requirement. For seniors whose financial lives have undergone significant changes, who have started receiving inheritance payments in installments, who have sold a property and are depositing proceeds in stages, who have begun helping adult children with regular cash transfers, or who have any other completely legitimate reason for making regular deposits in amounts that happen to fall below $10,000. That pattern of deposits can look to an algorithm that has no context about who you are, exactly like deliberate structuring. As Treasury Secretary Janet Yellen explained, if somebody reports an income of $10,000 and they had $3 million go out of their checking account, that tells the IRS that's an individual you might audit. The underlying principle is that the IRS and FinCEN are specifically looking for mismatches between what your bank account shows happening and what your tax return shows as your income. In 2026, with fully electronic payment systems making that cross-referencing faster and more automated than ever before, those mismatches are being caught at a speed and scale that has no historical precedent. Let me tell you about a situation that has played out for real Americans in documented cases so that the abstract risk I've been describing becomes something concrete that you can actually picture. Understanding that this has happened to people who did nothing wrong is what makes the preventive steps I'm going to give you feel genuinely urgent rather than theoretical. A retired farmer in the Midwest sells his tractor. He receives cash from the buyer, a neighbor he's known for 30 years. The sale price is $47,000, negotiated and agreed upon fairly. The farmer doesn't have a lot of experience with large financial transactions. He's heard somewhere that banks get involved when you deposit large amounts of cash. He decides to deposit the money in installments, $9,500 at a time over the course of several weeks, to keep things simple and avoid what he imagines will be an uncomfortable conversation at the bank. Every dollar of that $47,000 is legitimate. Every dollar is traceable to the sale of a tractor he owned outright. Every dollar will be correctly reported on his tax return as income from the sale of farm equipment. But the pattern of $9,500 deposits made deliberately, repeatedly, in amounts chosen specifically to stay below the $10,000 reporting threshold is structuring under federal law, a criminal offense with a maximum of 5 years in federal prison. The IRS Civil Asset Forfeiture Unit seizes his account not because of the tractor sale, not because of any tax problem, solely because of how he deposited the money. He eventually recovers most of his funds after more than a year of legal proceedings, but only after spending significant money on legal representation, only after the emotional devastation of having his account frozen with no warning, and only because he had a receipt for the tractor sale that could document the legitimate source of the funds. The farmer's situation is not unique. Structuring will get you in hotter water than depositing $30,000. As one enrolled agent who represents taxpayers before the IRS explained, because structuring looks like deliberate concealment in a way that a single large legitimate deposit simply does not. Here's the complete practical protection framework that every senior with a checking account needs to understand and apply right now. The first principle is absolute and has no exceptions. Never break up a large legitimate deposit into smaller amounts specifically to stay below the $10,000 threshold. If you have $15,000 in cash from selling a car, deposit $15,000. Your bank will file a currency transaction report. That report will go to FinCEN and nothing will happen to you because the report simply documents a large cash transaction from an account holder who deposited their money transparently and in full. The currency transaction report is not an accusation. It's not an audit trigger in isolation. It's a routine administrative filing that banks make on millions of transactions every year from completely legitimate customers. The second principle is documentation. For every large deposit you make, keep the documentation that explains where the money came from. A bill of sale if you sold a vehicle or property, a copy of the estate distribution notice if you received inheritance funds, bank statements from a prior account if you're consolidating savings, a letter from your financial advisor if you're reallocating investment funds. The documentation doesn't need to be submitted with the deposit. It needs to exist in a place you can find it, in case your bank ever asks where the money came from. The third principle, and this one is specifically relevant for the pattern risk we covered, is to notify your bank in advance whenever you expect to make a series of large deposits from a single source over a defined period of time. A 5-minute conversation with your bank's customer service line explaining that you're depositing the proceeds from a property sale in several installments and why creates a record in your account file that provides context for the deposit pattern before the automated monitoring system has any reason to flag it as suspicious. The fourth principle is to call the IRS or a qualified tax professional before you deposit any large amount of cash from a source whose tax treatment you're not entirely certain about. The intersection of large cash deposits, federal reporting, and income tax reporting is precisely where mistakes compound into problems that are far more expensive and far more difficult to resolve than a simple phone call would have been beforehand. The fifth principle involves your IRS account. Log into irs.gov, create or access your online account, and check your transcript for any active notices, proposed assessments, or collection actions that may have been generated by mismatches between what your bank has reported to the government and what your tax returns have shown as your income. If there's a discrepancy, catching it before it advances to collection action costs a fraction of what resolving it after a bank account has been levied will cost in money, in time, and in the kind of stress that no retired American should have to manage because of a rule they never knew existed. I want to close with something that goes beyond the mechanics of the $10,000 rule. I think the most honest and most useful thing I can do for the people watching this video is to explain why this rule and the enforcement framework that surrounds it creates consequences that feel deeply unfair to ordinary Americans, even when they're technically operating exactly as the law intended. The Bank Secrecy Act and the Currency Transaction Report System were created to detect money laundering, drug trafficking, and organized crime. The people who wrote that law in 1970 were targeting specific serious criminals, not retired farmers, not widows depositing proceeds from estate sales, not seniors receiving inheritance distributions from deceased parents. But the mechanism they created, an automated pattern based algorithm driven reporting system with no ability to distinguish innocent intent from criminal intent, captures innocent people alongside the criminals it was designed to catch. The Civil Asset Forfeiture Authority that allows the government to seize funds without a criminal conviction, shifting the burden of proof to the account holder to prove their money is innocent rather than to the government to prove it was obtained illegally, is a power that has been documented in published reporting, congressional testimony, and legal advocacy organizations' case files to have caused genuine serious harm to people who had done nothing wrong. Knowing this doesn't change the law, it doesn't create an exemption for you, but it does explain why taking the 5 specific steps I gave you in this video is not optional or excessive caution. It's the minimum responsible action for any senior who has a checking account and who is unwilling to discover through experience rather than education exactly how unforgiving this system can be for the people it catches unprepared. Subscribe to Real Value Tax for weekly updates on IRS rules, banking regulations, and financial protection strategies for American seniors. Hit the like button if this video gave you information you needed. Share it with every senior you know who has a checking account, which is every senior you know. Drop a comment below and tell us, did you know about the structuring rule before watching this? Stay informed, stay protected. See you in the next one. There's one more dimension of the $10,000 rule that almost no coverage of this topic addresses directly, and it's the dimension that matters most for the specific financial situation of retired Americans in 2026. It's the interaction between the Currency Transaction Report System, the Suspicious Activity Report System, and the IRS's automated underreporter program that cross-references bank-reported data against individual tax returns. These 3 systems don't operate in isolation from each other. They feed each other. Understanding how they feed each other is what transforms your understanding of the $10,000 rule from a simple banking fact into a comprehensive picture of the financial surveillance infrastructure that surrounds your checking account right now. When your bank files a currency transaction report on a large cash transaction, that report goes to FinCEN, which shares it with the IRS, the FBI, the DEA, and other federal agencies as appropriate. The IRS then has the ability to cross-reference that currency transaction report against your tax return for the same year. If the report shows a large cash deposit into your account and your tax return for that year doesn't clearly account for the source of those funds, as either taxable income that was reported or non-taxable, receipts that are clearly documented and excluded, the automated underreporter system can flag the discrepancy and generate a notice. When your bank files a suspicious activity report on a pattern of transactions, regardless of whether any individual transaction crossed the $10,000 threshold, that report also reaches FinCEN and can be cross-referenced against your IRS records in exactly the same way. The result is that the $10,000 rule and the suspicious activity report system collectively create a financial monitoring net that's significantly wider than most seniors realize. You don't need to make a single deposit above $10,000 for your account activity to generate a federal report. You simply need to have a pattern of transactions that your bank's automated monitoring system interprets as potentially suspicious. That pattern report can then trigger IRS matching against your tax return independent of any individual transaction size. For seniors in 2026 whose bank accounts receive Social Security payments, pension distributions, IRA withdrawals, and any other income alongside occasional large cash transactions from legitimate sources like vehicle sales, estate distributions, or property proceeds, the potential for unintentional mismatches between what the combined federal reporting systems show and what the tax return shows is larger than at any point in the history of these programs. The electronic payment transition has made those systems faster. The automated underreporter upgrades have made the matching more comprehensive. And the seniors who walk into this environment without understanding how the pieces connect are the ones most likely to receive a notice they weren't expecting about money they didn't hide and taxes they didn't intentionally avoid. The practical conclusion from everything covered in this video is simpler than the underlying complexity might suggest, and I want to state it as plainly as possible so it stays with you long after this video ends. The $10,000 rule is not your enemy if you understand it. The currency transaction report is not a threat if you're depositing legitimate money transparently and in full. The suspicious activity report system is not a danger to you if your deposit patterns reflect honest financial behavior rather than deliberate avoidance of reporting thresholds. The IRS automated underreporter cross-referencing is not a problem if what your bank account shows and what your tax return shows tell the same story, and they will for anyone who deposits their money honestly, documents the source of large receipts, reports their income accurately, and takes 5 minutes to verify that there are no active discrepancies sitting in their IRS online account right now. The seniors who are getting hurt by the system are not the ones with the most complicated finances. They're the ones who made one uninformed decision, breaking up a large legitimate deposit into smaller amounts because someone once told them it was smart, and discovered too late that the advice they received was the exact behavior that federal law treats as a criminal act, regardless of where the money came from. The protection is not complicated. Deposit your money in full. Document where it came from. Notify your bank in advance of unusual large transactions. Report your income accurately and completely on your tax return. Verify your IRS account for any active notices or discrepancies. Those 5 steps cost you nothing but time and attention, and they build a wall between you and a legal system that is powerful, fast, automated, and entirely indifferent to whether you knew the rules before it caught you not following them. That's the honest reality of banking in 2026. The seniors who know it are the ones who never have to learn it the hard way. Subscribe to Real Value Tax for the information you need before it becomes the problem you can't afford. Stay informed, stay protected.